advisors and their clients, but not all visual communication tools are created equal. With Y charts, each output is a powerful visual that brings your analyses to life and intuitively explains the why behind your strategy. Go beyond a simple price chart and educate clients about the levers that truly impact performance or risk, and emphasize your most important insights with flexible chart annotations. Plus, custom branding, colors, and disclosures position you to fully own those insights. Go to ycharts.com to start your free trial. My name is Michael Guyette, publisher of the Lead Lag Report. Joining me today is Katie Stockton. Katie, I know a lot of people are familiar with you, but some people may not be. So maybe give a quick bio on your background. How'd you get involved in markets? What have you done throughout your career? And what are you doing currently?
Of course. Yeah. Thanks so much, Michael. And good to be with everybody this afternoon. There's never a dull moment in the market. So, and of course, tomorrow we have FOMC. So exciting times as always, right? Now, my perspective is as a technical analyst. So I've throughout my career done charts and primarily focused on US equities, but with a little, macro dashed in there just because obviously Treasury yields and the likes, they do influence equity. So we focus there as well. We publish research now for Fairlead Strategies, which I founded in 2018. And we have, I believe it's 7 research reports in total that we're publishing, covering everything from those macro technical forces down to the individual stock level. We get into sectors, we get into crypto, obviously US equities and sector rotation. We also manage an ETF, the Fairlead Tactical Sector ETF or TACK, and that's new as of March of 22. Before Fairlead, I was working primarily as a technical analyst, but with some deviations on that career path. I started my career in San Francisco in the late 90s. So those were good times. And I studied actually finance and had even exposure to technical analysis coursework in college and had an internship at Dorsey Wright. So for those of you who are technicians out there, you probably know Dorsey Wright and their point and figure charts. So I was one of the interns and actually worked there for 2 years doing hand charts. So there's really no better way to be close to the markets and to hand chart something. But it set me on the path to do what I do now. And the bulk of my career was spent as a publishing technical strategist. So I worked most recently at BTIG, which is an investment bank in Manhattan. And before that at MKM Partners. I had a stint at Morgan Stanley where I developed a lot of my methodology working under Rick Bensignor. And the methodology really was shaped over the course of the 25 plus years that I've been doing it. And I have a very systematic approach. So I use a lot of technical indicators that will give us binary takeaways, I would say. Is it a buy or sell signal? Is it positive momentum or negative momentum? Anything that takes the guesswork or the subjectivity out of the markets is good, but we are big believers in price as fact. And, everything around that is sort of speculation and ends up in price. So we're big believers in analyzing price trends, support and resistance levels, and to try to understand the market psychology and sentiment just around that, what creates those trends.
All right. So a lot of things I want to pick your brain on. When I present at CFA chapters, I always distinguish between intermarket analysis and technical analysis because, most classic technicians would argue it doesn't matter what you're looking at. It's all about price. Doesn't matter if it's a stock, bond, Apple, dollar, Bitcoin, whatever it is. But since you mentioned the FOMC and Treasury yields, I'm going to make the assumption that of the charts that you look at, Treasuries may be among the more important ones to focus on as opposed to thinking that a chart is a chart.
Yeah, for sure. I mean, the intermarket stuff does hold a lot of weight in our work. But when we analyze Treasury yields or crude oil or anything that influences equities, we first try to look at it from kind of like in a vacuum where we're not incorporating that intermarket analysis, at least not yet, because we want to really have a pure view of the trend, a pure view of supply and demand as it pertains to treasuries or anything related to it. Treasuries, of course, have been exceptionally important of late, and sometimes that may change. There's always I call it the macro data point du jour, but they've really become so relevant to market sentiment. So we've been hyper-focused there. And we can see correlations, historical correlations that we can at least identify and let sort of inform our bias. We're not ones to necessarily make calls based on correlations, but if it makes sense from a momentum perspective for yields or for the S&P 500 as one, well, then all the better, right? Because if something is there, technically speaking, and has a basis in intermarket analysis, then that's great. It's that much more powerful. And when things are diverging from what would be a historical norm, there's actually information in that as well. And we can try to understand, well, which one is more likely to mean revert, I guess, to that kind of normalcy. So yes, hyper focused on yields, of course, right now. And that influence on sentiment is really very prevalent as we get into the FOMC announcement tomorrow, because we have 10-year yields right up against some very key resistance on their chart.
Do you get a sense that the narrative around the death of the bond bull market, that is maybe coming a little bit late in the cycle? I mean, you've had 3 years now of long duration treasuries in particular losing, which has never happened before, right? Even going back to the 20s, at least from the data that I've seen. Is there a possibility that we could actually see a cycle for the next several years where bonds actually do outperform and treasuries in particular?
The primary downtrend still has a hold on any treasury benchmark. We use TLT as one example. It's an ETF representing the 20 plus year treasury bond. And you can see the downtrend. You can zoom out and see it across time frames. There is support from the 2022 low. So from a more short to intermediate term perspective, we would look for stabilization. And we've been making the call that we would expect to see sort of digestion from treasury yields near current levels because of the resistance. And then also because our overbought, oversold metrics, including the DeMark indicators that we use, those are showing signs of sort of minor downside exhaustion for the likes of TLT and upside exhaustion for the likes of 2-year yields, for example. So we are looking for digestion as part of a counter trend move. Without question, the downtrend has lost downside momentum. If you use something like the monthly MACD indicator, it's a long-term trend following gauge that you can apply to the monthly chart. And you'll see that it had been on a so-called sell signal for close to 3 years. And now it's sort of whipsawed and it's pinched somewhat more neutral in its bias right now. But we tend to not sort of get too excited about that until we actually see a momentum shift more short to intermediate term that's meaningful. And we certainly have not seen that yet from TLT or any similar benchmark. So I'm going to trust that the downtrend is intact, but looking for stabilization near support. We believe, just from a technical perspective, that treasury yields have seen a secular shift, one that we haven't seen the likes of for most of us in our careers. So we saw a secular downturn in the 80s, and now we believe we have a secular upturn. But that doesn't mean yields go straight up all the time, nor does it mean they have to get back to levels that we saw in the 80s. It does mean, though, that we would expect higher lows over time. There can be counter trend moves that can have a pretty extended duration on the way down. We certainly had, 2-year counter trend moves where yields were moving higher. And along those same lines, we can have yields moving lower for a year, 2 years, even more, but still within the context of that secular shift. So it just depends on whether we can see the resistance level by yields cleared. Again, we don't think that's going to happen near term. But it depends on the reaction to what the FOMC states. I think that's really the influence there. Importantly, when we're looking at levels and watching for breakouts and breakdowns, if we were to see a breakout, we'd want to make sure it's confirmed, especially when it's a news-driven type of move. And by confirmation, we mean we want to see a couple of good, solid weekly closes above a long-term level. And that would then suggest that we've seen a shift, right? So a shift higher in yields and likely a breakdown in the likes of TLT. So we would be responsive to that kind of event, even though our indicators at this stage suggest that we'll see more sideways to lower end yields. We would certainly respond to some kind of breakout if we had to.
Speaking about sideways, I feel like that's a good transition to the parts of the market that I would argue are not in quotes, new bull market. And I've been trying to hammer this more recently, but if anybody were to pull up a chart on Russell 2000
Mhm.
IWM, it doesn't exactly look like a new bull market, right? Neither does Europe VGK or emerging markets broadly EEM, and certainly not XRT, the retailer ETF. So there's the narrative of new bull market, rising tide lifts all boats, but the reality is there's been a lot of divergence, right? Which I'm sure we can kind of expand on. But that does relate to treasuries as well, right? I mean, I have to imagine the reason why small caps have, on a relative basis, performed so poorly against large caps is because of the feeling or the fear that high rates for longer will impact the likelihood of zombie companies surviving somewhat as they roll over their debt. But how do you think about the interaction of the sideways parts of the equity market to the yield move in
Well,
general?
I would imagine it's certainly related. The charts won't answer that for you. They'll never tell you why something's happening, but we can certainly draw that conclusion, I would say, because also outside of even the small cap arena, think about the sectors. Well, the sectors, one represented in this small cap arena, largely as sort of value oriented. But then also, the more defensive sectors of the market, which tend to be interest rate sensitive, you would have expected those to kick in with some relative performance over the past, month and a half during the corrective phase in the equity market. And it really hasn't happened yet. And so we see that as a function of the level of treasury yields. Now, it could change. So again, we're not going to rely on that. And we are starting, in fact, to see some signs of downside exhaustion in the ratios of these more defensive sectors, the likes of consumer staples, utilities, and REITs. So we're looking for sort of a relative relief rally, if you will, there. But I think your point is even bigger in that it addresses breadth or market participation, which I think this year has become somewhat notorious for not having good breadth. And so it was more prevalent at the start of the year when the leadership was quite narrow on the upside to the mega cap stocks. And that's somewhat reflective, I think, of them even being treated as a little bit safer than perhaps, a smaller mid cap growth stock. So there was a little bit of a safety trade there. But then when we did see breadth expand, it didn't really hold very long. We saw breadth expand for a couple months, and it was enough to yield a reversal that was meaningful in the cumulative advanced decline line for NYC securities. So we think it holds promise, but it wasn't, something that saw a great upside follow through in terms of breadth expansion. So breadth remains somewhat challenged in this environment. We think what would trigger a shift towards much better breadth would be a breakout by the S&P 500. So that's something that's going to get confidence restored to the equity market, in our opinion, irrespective of what yields are doing. So we are hoping that we see a breakout. For us, that would need to be sort of those two consecutive weekly closes above 4,600 by the S&P 500. And that would be a nice bullish catalyst for breadth to improve. So then you could theoretically see the leading sectors still, exhibit leadership. So still having outperformance, say, from communication services, technology, consumer discretionary, or at least segments of it. But then also the participation to be there from these other sectors, which have been largely out of favor in relative terms. We're seeing some stabilization, of course, in financials. It's a bit early, I think, to suggest that will be lasting. We've seen a nice rebound out of the energy sector in relative terms. We think that may be somewhat short-lived, but we are bullish right now on crude oil and also natural gas. So we think there's probably a little bit more life to it. And then, the cyclical sectors are just collectively more, I'd say, neutral, closer to in line to the S&P 500 in relative terms. It's going to be the defensive sectors that'll be interesting to watch, I think, finally to see perhaps some participation there. And maybe it's going to be less related to the level of treasury yields, which I think has been the proposed drag there, but more whether they're accelerating to the upside or are they just grinding sideways. It's perhaps the velocity of the move in treasury yields that seems to have the bigger impact on market sentiment. So maybe once the market embraces the fact that we are not too far from 5%, then it becomes more about, are we really running up quickly, or are we just kind of grinding sideways to higher? It just depends on, of course, the influence on the market psychology.
I want to relate that to the name of the space I put, which is how to spot a stock market correction. I hear you on the S&P breaking out would probably cause some momentum into small cap and improved breadth. I don't necessarily disagree, but when breadth is this poor, is it usually more of a leading indicator where, as the argument goes, the generals fold soldiers, or is it the other way around on average? And I say that because there's a nuance in terms of how to think about oversold relative ratios, right? I mean, markets tend to crash from oversold levels, but they also tend to rebound pretty strongly from oversold levels. In this case, we're talking relative, right? But do you view the weaker breadth as an ominous warning that the generals start to break, that large caps end up catching down, or the other way?
Yeah, I think it's more of a coincident indicator of what we've seen. So if you go back and you just look at the historical cumulative advanced decline line, the corrective phase is there. We have to say corrective because theoretically it's in this kind of secular uptrend if you go back on the monthly chart back 20 years or so. But those corrective phases have been associated with bear market cycles. So you just see that breadth weakness during the cycle. It doesn't appear, when you just look at it from this perspective, to have really any lead to it, but rather a bit more of a coincident downturn with the market. So I don't know. I've not done any studies on, if they shoot the generals last, that kind of concept. But because the generals have been so strong this year, I feel like that's not really part of the conversation this time around. I think it's just more we saw breadth contract and it still hasn't really recovered in earnest from the 2022 bear market cycle when it was really more pronounced in its contraction. So we think that it's not providing any kind of leading indication, but rather just confirming what we already know from a momentum perspective. And again, we would expect to see it improve if we see, either a corrective low established by the S&P or a breakout. And, that kind of brings us to the importance of the momentum gauges in our work. So the breadth, I would say, is something that will give us what's like a backstory. And it'll tell us how easy the market is, because when breadth is not great, it just makes it a more difficult tape to take advantage of, right? You have to be sort of more narrow in your exposure in order to take advantage of an environment that has weaker breadth. And that's why this year, I think, has been just challenging for all of us, because, if you weren't in those right stocks, it was much harder to find outperformance and, stocks that were staying true to their fundamentals, that type of thing. So the momentum we put a priority on. We always, are really concerned with momentum, especially on a long-term basis. And long-term momentum has turned to the upside, but it's also challenged right now by long-term overbought conditions in a way that it wasn't really challenged this early off of the past bear market cycle. So when we saw the advance off the 2009 low, we weren't as overbought in its early stages as we are now. So I think there's that challenge. Is momentum going to be strong enough for the market to sustain that overbought condition? Because an overbought condition in and of itself is not bearish, but it makes it more difficult for the uptrend to sustain itself when, you just don't have that strong momentum. But we've seen momentum shift to the upside behind the S&P 500, behind the NASDAQ 100. It shifted even behind the Russell 2000, as much as that trend looks a bit more neutral, perhaps. And we've seen with that, the leading sectors also gain long-term upside momentum. So in our TAC ETF, as an example, we hold technology, we hold communication services, we hold consumer discretionary, and we hold industrials, in part because of their long-term momentum shifts. We don't hold any other sectors right now because they just haven't met enough of our qualifiers in terms of their long-term momentum shifts to dictate adding to the portfolio. We hope for that to be the case sometime soon with the breadth expansion, but we just don't have strong enough momentum as of yet. And again, it goes back to that, breakout. As we see the breakout, well, that is something that can certainly foster that momentum. And in the interim, we're respecting the corrective phase that's underway. The indicators started to roll over in a timely fashion when the correction unfolded, and they have yet to flip, right? They have yet to sort of roll up after having rolled down.
By the way, I'm glad you mentioned that this has been a difficult year, because you wouldn't think that from the options traders that are playing NVIDIA and names like that. I mean, the reality is, I always go back to, and this kind of me putting my CFA charter hat on, how do you beat the market, in quote? Beating the market being the S&P. From an asset allocation perspective, there's really only one of two ways if you're going to be equities. You either beat large caps by tilting smaller, right? Mid cap, small cap, domestic, or you beat the S&P by tilting international. Like on a very, kind of blunt force way, those are the only ways to beat the average. You have to choose the right average. The problem which you alluded to with a year like this, with the narrowness and the breadth, is that it's been a whipsaw city for anybody trying to play what looks like, at least a shorter term, burgeoning momentum by tilting small, tilting mid, or by tilting international, because it's been so overwhelming, the momentum on those mega cap names driving the headline averages.
Yeah, for sure. And that's the shared frustration, I think, from investors at this point, where their returns aren't looking like the NASDAQ 100 as one. And that can be frustrating, but there are certainly worse things than, missed opportunity on the upside. Obviously, preserving capital should be number one when you have the weak breath. You want to make sure that you're not digging yourself into a hole, obviously, and starting from a solid base in your portfolio. We always look for outperformance, typically from technology, but broader than that, at growth versus value, when we have a stronger tape. And we also look for outperformance from just higher beta areas of global markets in general. So that would also include, as you referenced, the small and mid cap arena, especially on the growth side. Growth has largely outperformed this year, and a lot of that has come from the mega caps. But we did see, when the tape was at its strongest, relative performance from small and mid cap growth as well. It was hard to capture because you had to be there, for the right weeks, not the right months necessarily. But we do look for that to kind of go back into favor whenever this corrective phase is over. And then it's a question of, is it just a short-term opportunity or something that becomes more long-term in its orientation? Since the high beta complex is a great way to supplement a portfolio with a sort of core U.S. equity large cap exposure, to have that is really key. And then to supplement it with, I would say, something that's more opportunistic or higher beta, perhaps, once we have more confidence that this corrective phase is over. I think that's a great way to position, for outperformance. And for us, because we're somewhat equity centric, we always think high beta while we're looking at, cloud computing stocks and things of that nature. But certainly you can look overseas as well. In tomorrow's research report, we're going to talk about emerging markets and some long-term prospects there. There's actually some signs of downside exhaustion in the ratios of emerging market benchmarks versus the US. So it would be somewhat high risk to take a position until we feel that more confidence that the corrective phase is over. But pretty interesting to see those signs of downside exhaustion unfold in the same way that they did at the last sort of low in relative terms. So certainly can source international equity markets where you find protection otherwise, in a less strong equity tape tends to be from treasuries and precious metals, of which in the TAC ETF, we have had exposure to both short-term treasuries, sort of 1 to 3 year, long-term treasuries, and also gold. We really like the idea of diversifying risk-off exposure, or what we consider to be risk-off exposure, because that protects to some degree in, a bear market cycle across asset classes, which we certainly had at times last year. So, we do believe in the traditional sort of outperformance historically from treasuries and precious metals versus equities, but that would require sort of a weaker equity market tape.
I see a few people want to ask questions. Those that are queued up, just check your DMs so I can coordinate with you, and I'm happy to bring you up. As you were mentioning it, Katie, I pulled up the Russell 1000 growth to Russell 1000 value, IWF, IWD ratio. And, last year growth was pretty solidly and consistently underperforming value. Growth being value being more financials, and energy. And then it looks like what really broke the downtrend of that style rotation was the regional bank crisis, right? In March, where you had this massive outperformance of growth versus value. And then that kicked off a lot of the tech momentum, you can argue, on a relative basis. And that ratio right now looks like it's basically just kind of sideways consolidating, maybe in a distribution pattern back to, looks like May 2020 levels. Do you think that we're at some point, I mean, everybody's been talking about this for a long time, but are we at some point going to really have a kind of a multi-year secular shift where value ends up outperforming growth? Because that does inform investors how to think about sector allocations, and even domestic versus international emerging markets tend to be more value style tilted, and small caps are even more value style tilted on a core basis than large caps.
Yeah, so my indicators are probably best suited to give us a sense of the trend over the next year, not necessarily 3 to 5 years. But when I look at those same small cap growth versus value ratios and large cap growth versus value ratios, very simply, when you reference the 200-day moving average, you'll see upturns that actually are somewhat promising. So while we have some digestion and consolidation in both ratios, I would say that the prevailing trend does seem to favor growth. It wouldn't necessarily apply for, again, the next 3 to 5 years based on our metrics, but for the next year or so, it seems to be somewhat promising. I mean, they have higher lows in place. We have seen some exhaustive signals that are already really running their course. So we're probably about halfway through the implications of the exhaustive signals that we saw ahead of the corrective phase. Those were from the DeMark indicators. So we're not totally out of the woods from that yet. But I would expect ultimately to see these continue their newly established uptrends after what we saw from 2021 to 2022 in terms of a downward reversal. Is this part of, and I'm looking at history just for the past few years. I'm not looking at decades here. And there is certainly the potential that this uptrend is cyclical, not secular, right? And so we don't have that indication, but it certainly could be. We don't really have a way, as you know, Michael, to predict these things, right? We have to be somewhat reactive in our work and just put sort of the weight of the evidence in our favor. And the evidence being historical trading, historical correlations, trend following indicators, things of that nature. And for right now, the side of the trend that I want to be on is favoring growth, but, perhaps waiting until we see a little bit more proofs from the S&P 500 that it's ready to get going again.
Just to reset the room for the remaining minutes, everybody please make sure you follow Katie Stockton here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast under Lead Live, under Spotify, Apple, YouTube. Let's talk about time frame for a bit. As somebody who's a technician and studied markets for a while, where do you feel most confident in a sort of a short-term outlook, intermediate-term outlook, or longer-term outlook? Because I think, I always go back to, you can be bullish and bearish at the same time, but at least from my vantage point, it seems like the short term may actually, oddly enough, I'd argue, be in some ways more observable and more actionable than something very long term.
Yeah. And listen, it's almost like it's fractal, right? And where you can see a trend from a long-term perspective and have multiple trends on shorter timeframes in opposite directions. So it makes it somewhat hard, right? Because the folks that you talk to, they all have different time horizons. So we'll have subscribers to our research who are focused on the next week. Yeah. And then we'll have some that are focused in that 3 to 5 year time horizon. So we need to cover all of our bases in our research. And we often will show monthly bar charts, and just as often we'll show daily and even have a 60-minute chart that we put in our morning note. So we cover all those time frames, and there are certainly times at which they conflict. So we give biases that are long-term and more short to intermediate term in our work. And I'd say that the confidence is probably about equal over the two time frames, broadly speaking. But we are big believers in long-term investing because you could treat a lot of those short-term moves as noise. I mean, if you go and back test anything and, by sort of narrowing your time frame, I sense that you're probably creating more trading volume and transaction costs than you need to. and that the short-term work should actually be used more for market timing and risk management, whereas the long-term work is really where you want to be invested, right? So if you have a security you want to add exposure to, well, go ahead and number one, make sure the long-term trend is favorable or long-term setup. And then two, go to the shorter term indicators and just make sure that you're getting a good entry point. And that would mean something that's closer to a support level, that's not terribly overbought with a sell signal, or that has some kind of positive catalyst like a breakout. And that just putting more of those odds in your favor and just trying to, stay on the right side of the tape, essentially. And the good thing about the charts and technical analysis and the identification of support and resistance is we always have a place at which, things change, right? So not to talk out of two sides of our mouth, which we try not to do, but there is always essentially a stop loss on a view. And we can also use levels to establish actual stop losses. A great risk management tool that is derived from technical analysis, you can identify support and say, well, below that support level, that would make me uncomfortable because that would reflect a great enough loss of momentum. It would mean that the buyers just aren't there anymore. And so there's always that sort of defined line in the sand that you can derive from the charts.
Some of the audience, if you're there, go ahead. And again, if anybody wants to come up, click that bottom left mic request button.
It's really more of a macro question. I hang out with a lot of macro strategists and they're much better qualified than I am to address that question. All I can do from a technical perspective is just kind of give my sense of the trends and where they might pivot in terms of, okay, well, 2-year yields for one, they're right up against their March high, just like 10-year yields. And so what we can do with that is try to understand essentially next levels, right? And we can react to breakouts and breakdowns. And then, of course, identify the influence on the yield curve, which we don't really reference much in our work. It's with the lead time on the yield curve. It's something that as a technical analyst, it's quite uncomfortably long for me. Anything can happen in 18 months, right? So we just prefer to watch the trends in both 2 years and 10 years. And what we're seeing in 2-year yields is very similar to 10-year yields in that we have resistance effectively in line at about 509 for the 2-year. There are signs of upside exhaustion that would support a pullback. The 50-day moving averages have been gauges of short-term support for both. So where we would expect yields to contract more in earnest and likely faster on the 2-year than the 10-year would be on a breach of the 50-day moving average. So for the 2-year, that's around 490. Think of that as initial support. Secondary support, we're using something called the cloud model, which is maybe not terribly popular, but a really great visual gauge of the prevailing trend and also support and resistance. And referencing the cloud, we're talking about 430 on the 2-year. So that obviously would be a pretty major move if we saw that 50-day moving average taken out. And conversely, resistance levels are equally sort of crazy or at least seem crazy in terms of how far they are away. And sort of equivalent on the downside for 10-year yields, if we're looking at them trading around 434, the 50-day is at 410. And then the secondary support level is around 375 based on that cloud model. So those are our relevant levels. What tends to upset people when I say it is that if we see the breakout by both or by 10-year yields in particular, the next resistance levels are really very well above. And it doesn't mean that we have, that becomes our near-term upside objective by any stretch, but it does suggest that we really have to respect these uptrends and their sustainability would be enhanced by the breakout. So above 434, the next resistance is 5.25. And that's not something that should be relevant anytime soon, but it just creates more, risk to the upside, more likely higher for longer. And so I'm sorry, I can't address the question as to the Fed pivot. That's really not my area of expertise, but hopefully we'll get some sense of that tomorrow.
Talk about how you factor in sentiments in the way you look at markets. I mean, you can always say that sentiments in the charts, I get that. But is there anything that you look at from a data source perspective that inform you of extremes in a particular position or viewpoint by, in quotes, the crowd?
Yeah. And again, that's what we're trying to measure, right? With the price trends is how is sentiment manifesting itself in supply and demand. And I think it's This is where, by the way, you see divergences from fundamental analysis. And we are big believers in fundamentals as being the drivers of trends long term. But there are times at which it just gets really disjointed. And I think this is why the CMT Association or the Chartered Market Technician Association, their mantra or motto is navigating the gap. It's really kind of addressing the spread between price and what should price be from a fundamental perspective. And herein sort of comes the charts where they can help us navigate the gap at times. And it all comes back to sentiment. If there's bullish sentiment, well, even if it's a lousy company, it might get, lifted with the tide, as you mentioned earlier, and vice versa. So when there's a bear market cycle underway, boy, it feels like no stock is unturned by that bear market. So it begs for an understanding of sentiment, which we sort of garner a few ways. We have in our morning note, we publish a market internals table where we have a couple of sentiment readings in there. One's an investor poll. The investor polls can be really interesting. It feels, somewhat, I guess, old school in a way to go back and to say, hey, how do you feel about the markets? But there is value in that because where we find value is at extremes. When there's an extreme level of bearishness or bullishness in the market, well, that can be signs of an emotional sort of environment that tends to be the stuff of pivots, right? Sort of highs and lows. We almost always look at sentiment from a contrarian perspective, looking for those extremes. So when people are extremely bullish, that the indication would be that momentum could actually start falling off because the market's saturated. And so we will cross-reference the status of our sentiment data with our momentum gauges to have an understanding of, okay, the sentiment environment or backdrop is not great. So let's just really adhere to the momentum gauges, maybe even shorter term than we would have otherwise. If we see some deterioration, we'd be more inclined to act on it when sentiment is overly bullish, that type of takeaway. The other gauges that we use include the CBOE Volatility Index or the VIX, which we consider to be a transactional gauge of market sentiment. And that's something we even address in our morning note today to say, well, here's something else to watch to try to understand if the corrective phase is maturing in the S&P 500. The VIX holds an inverse correlation that's pretty reliable. And a lot of people will use VIX products as hedges at their own risk. It's quite a difficult sort of product to time correctly. But the VIX can give you a sense of, well, are people positioning in a way that shows that they're more bearish or more bullish just through these put and call sort of, or put spread or put options on the S&P 500. And then we also look at the fear and greed index. And that is something that's more of a sort of aggregate index that takes in different inputs and will give you a sense of how extreme the environment is. Again, more from a transactional perspective, looking at things like, the gold, the demand behind gold for one as a safe haven asset class, looking at things like advancers and decliners, which we would argue is more breadth oriented, but that's one of the components. And taken together with these three different sentiment metrics will collectively tell you how extreme the environment is. And it got pretty extreme actually in July, which is partly why we started to call for a corrective phase in August, because the sentiment environment was somewhat conducive to that. And it's since been relieved. We're now essentially in neutral territory. We certainly don't have an oversold extreme yet. There are environments in which we don't need an oversold extreme in order to get out of a corrective phase. So that's something that time will tell. We really treat the indicators the same way across asset classes. There are definitely some nuances to that I would say. I mean, for example, anything that has more deep global liquidity, the indicators will generally be just better for them. And so it's not to minimize the indicators for individual stocks, but individual stocks arguably are subject to the most headline risk. Take a small cap biotech stock, for example. That's where the indicators sometimes will be more challenged, and also support and resistance levels will be more challenged. But we'll apply the same methodology across the asset classes. And in terms of how to weight them, we're always looking for sources of outperformance to overweight. So the way we do that is just through analysis of the ratios. So we'll take a lot of ratios, often doing this on the sector front for our own work. We have in our weekly report, we'll have the sector or the S&P 500 sector indices versus the S&P 500 as our most common relative strength metric. And we'll analyze these ratios in the same way typically that we analyze price. We'll usually keep the indicators that we lay over the ratios a little bit simpler because we don't want to get too many derivatives away from the price itself. So maybe we'll throw on a moving average. In fact, I just put in my Twitter feed the growth versus value comparison. You'll see we have a 10-week and a 40-week moving average. I'm trying to replicate essentially the 50-day and 200-day moving averages on a weekly chart there. And behind the scenes, we'd probably also have the DeMark indicators at work to help us understand if something's maybe overdone on the upside or downside. But really more basic trend following gauges like those moving averages that you see there will come into play for these ratios. So I'd pay a lot of attention to the ratios and also be respectful of support and resistance. So we talked about emerging markets. We even, looked at the short-term treasuries. If you look at those ratios versus the S&P 500, they've certainly been downtrending, intermediate-term downtrends, within even longer-term downtrends, arguably maybe ranges of support levels hold. But you can say, well, there's support coming in line, so this might be a chance to at least temporarily either have you hold your existing exposure or increase exposure to position for a counter-trend phase of outperformance. It depends on how short term I think you want to get with it. But those ratios can be really informational. And we'll even adhere to ratios that are a bit more macro in our takeaway. We'll look at, gold versus silver, things of that nature, just to see if we can find any opportunities to take advantage of. With those ratios, you can at least decide which, as an example, precious metal that you want to take advantage of. We identified relative strength improving a while ago, and uranium as just one, as sort of an off our normal, I'd say the stuff that we write about is typically not that, but we found in our search for something that was actionable as the broader equity market started going into a corrective mode, uranium was one that stood out, of course, from a relative perspective. And so you can find these great opportunities using those ratios and not getting too complicated with the indicators. I'd say more accurately, we start top down because we're letting our views from the big benchmarks, for equities, for treasuries, for, global equities, things of that nature. We're starting there, and then we're framing the rest of it within that context. And the equity market takeaway from the major indices like the S&P 500, that is where a lot of our risk management comes from, because we are big believers that, again, when you see a bear market cycle, it tends to be really broad based, just given the sentiment shift. So you don't typically need to run out and sell a bunch of stocks. You can easily get hedged more from a top-down perspective. So we give a lot of weight to that top-down in a bear market cycle and start perhaps emphasizing the bottom-up work more when we have a bull market cycle to take advantage of, and we are rewarded for stock picking in a way that we haven't been probably for the last year or two, right? So we do both. Part of our process, just so everyone has heard it, our methodology, we have charts that have the same indicators across timeframes. So we're simultaneously looking at daily, weekly, and monthly charts, and we'll scroll through a whole universe of inputs, like global macro inputs is the way people would probably consider them. And then we have a process where, in preparation for providing long and short ideas to our clients, we'll go through the components of the S&P 500 and also look for thematic ideas in the small and mid-cap arena, which we put out via Substack typically. So we're doing a little of both, but you'll notice that when we are providing more short ideas, that's certainly driven by our top-down work. We have a new report called ETF Navigator. And in that, we cover about 55 different ETFs week over week. And we rotate. We always are focused on U.S. equities in each of those reports, but then we also will rotate in commodities, FX, and international equities, as well as fixed income. So we rotate through the alternative asset classes, looking at these ETFs. And it's a great way, we feel, to have like an apples to apples comparison of everything, almost like a chart book. more than sort of a long form research report, where ideally you can really see things emerging collectively. And I mean, boy, you go and look at these fixed income ETFs, they're all going to go the same way, right? So you really need to directionally, look at the ratios to find sources of outperformance or underperformance. In addition to the ratios to get to that point, we'll also use something called relative rotation graphs. And these RRGs, which were developed by Julius de Kempenaar. He's based out of the Netherlands. And he has created this kind of normalized view of rotation. But we all know there's rotation on the sector front, but cyclicality goes much beyond that. You can see it in countries versus the broader sort of world benchmarks. You can see it amongst asset classes. You can see it amongst semiconductor stocks versus the semiconductor sector. And so we'll, in that ETF Navigator report, publish these RRGs comparing the sort of ETFs that represent various subsectors or subgroups within the broader group. So it can really be an interesting exercise and help you determine if your positioning is aligned with what's happening from sort of a relative momentum perspective. Are you overweight the things that are pointing higher in kind of the leadership area, or these ones that are losing upside momentum in relative terms? And then when you can have that apples to apples comparison, I think it gives you an advantage from more of like a holistic portfolio management perspective.
Do one last question, and then I've got another space at the top of the hour. First of all, I appreciate you saying that, although I want to stress this is Katie's show. So, but just because Katie's a CMT charter holder herself, right? The Dow Award came from the CMT Association.
Right.
And maybe that's a good pivot to kind of maybe wrap the space up, because you alluded to it a little bit on utilities, which, listen, we could argue that myself, that either way they were due to have some snapback rally. Right? I mean, they were so bombed out on a relative basis. That ratio was lower at a certain point than the November 2021 lows. And you and I both know, Katie, that a lot of the kind of old school technicians like Edson Gould, Ring, they'd always look at the utilities as a key sector because of how closely it's tied to the bond market, to rates, to defensiveness. Just in terms of the very short term, again, I hear you. The other defensive sectors have not yet fully responded, staples, healthcare in particular. But does the magnitude and speed of the utility strength maybe kind of, put the contrarian signals up for maybe something deeper or more imminent? And I say that because as it relates to the Dow or paper, going back to the 1920s, when utilities outperformed the broader stock market on a short-term basis, generally volatility is higher, and generally most major tail events, you tend to already have utilities strong in advance. So they do tend to warn you, not always, but they have a pretty good track record in terms of identifying, from a relative perspective, possible extremes, right, in beta. Does that magnitude mean anything to you? The speed with which it moves less?
I would say not yet. So we actually had it in the ratio that we track of utilities versus the S&P 500. It was in early September. We're still September here, just a couple of weeks ago, that we had one of these DeMark counter trend signals that's short-term in nature. And it's taken the ratio right up to sort of its 50-day moving average, which is where, if you go back to sort of the March corrective phase, that's where we pivoted lower again. So I'm not convinced that it's really out of the woods yet. But what I am somewhat encouraged by is that this phase of outperformance has basically protected support in absolute terms. There's a bunch of sort of previous troughs not far from current levels for XLU. And if you go way, way back, there is a gradual sort of secular uptrend that's still intact. So you can make the case for, at least in absolute terms, for more rotation into utilities. But in relative terms, I think it's still too early to suggest that this is something that will be lasting. Where we tend to see that would be if we had more than just a short-term counter-trend signal, which we don't have that yet. Or if we see more support discovery in relative terms, and already we see some here in absolute terms. So it could certainly switch that way. And Michael, I know, I remember actually when you got the Dow Award in 2014, it was very exciting. I feel like it was a nice event, and I got to see you receive that award. And, I think there's huge value in evaluating the sectors versus the market. I think it's some of the most, accessible, ways to take advantage of, what's outperforming in the marketplace. So even if we're not taking a macro standpoint on it and using it for implications for the markets, there's a great way to leverage these relative strength trends in terms of seeking outperformance, even in more of like a range bound environment. So we really encourage people to follow the ratios on the sector front and just look at the dispersions on the sector front over, year over year. It's really remarkable how huge of a spread you can have in sector performance diverging from the S&P 500's performance too. We had energy sector performance, relative performance for 2 years straight. That was just explosive versus the next runner up. And so to take advantage of those, I think the analysis of the relative strength trends can be really valuable. And, it's something we spend a lot of time on, as I know you do too.
Katie, for those who want to track more of your thoughts, more of your research, obviously you're doing media rounds quite often, but where would you point them to?
Yeah, so we offer free trials to the research. So for those that are interested in following not only the market views, but also trying to learn the methodology so that they can do more of it themselves, we'd encourage the free trial, which we offer for a month. And you can access that through our website, dispareleadstrategies.com. So I think that's the best way to do it. We certainly do, appear on CNBC occasionally and we'll tweet occasionally, but to really have the consistent, more systematic views, I think that's the way to go.
Again, everybody, please make sure you follow Katie Stockton. Thank you, Katie. It was a pleasure.
Thank you, Michael. I appreciate it. Have a great afternoon.